Hello and welcome to this ET Now special. It's a year that will be remembered for the startup ecosystem reaching all new levels, whether it's a new unicorn being minted every other day, but more importantly, also the year of exits. Exits have really given a new level of confidence when it comes to the startup ecosystem. We're going to be talking to some of the best in business about this. I've got two managing directors of Sequoia Capital, Mohit Bhatnagar, as well as G.V. Ravishankar, to talk about the year that has been, but more importantly, as we all have short memories as well, what's important for the new year, 2022, the lessons that we have gotten from 2021. Mohit, G.V., thanks so much for joining us here on ET Now. Boy, what a year it's been. Do you even remember, Mohit, what January seemed like? By that time, we hadn't had any big exit. There had been no IPOs. We didn't have so many unicorns being minted.
It truly does feel like India has turned a corner in terms of the average mass Indian turning to the internet for discovering and then consuming a bunch of products and services that they never did before. To put things in perspective, GV and I started doing this business in India along with our Sequoia team over 15 years back. And when we started, I think the GDP per capita in India was a paltry $800. It's more than 2.5x that today, and it's a different world that we operate in today.
Oh, absolutely. And GV, just picking up from what Mohit said, you guys can remind our viewers about being patient when it comes to investing, the idea of staying long term.
Yeah, absolutely. To echo what Mohit said when we started, there were probably less than 30 million what are called broadband users, and broadband defined as 256 kbps. And today, my son would not take anything below 500 mbps as any speed that's worthwhile having at home. So life has changed so much, and it's not been that long. It's 15 years. And, if so much can happen in the last 15 years, let's imagine what's in store for us for the next 15. So super exciting where we are today.
They do say patience is a virtue, and I think investors like Sequoia know that better than ever. So Mohit, you've been right at the helm of it, and I know that, unlike a lot of other venture capitalists, you don't like to gloat, or you don't like to have long threads on Twitter on lessons and things like that. But you had a big year, from a Zomato to a Freshworks listing in NASDAQ, right? What would you say are some of the big lessons that founders, startups, merchant bankers need to keep in mind?
Yeah, first, all credit to our founders that we work with. They inspire us every day. And for every, very successful entrepreneur that we know of today, you should be well aware that there's a whole batch and a tsunami of the next wave of entrepreneurs who want to go even bigger and better. So India is certainly, trending in the right direction. The world is evolving, and you have to evolve faster than that. It comes down to understanding what the average Indian wants to consume, or how they want to buy it. And if you are sort of being able to simplistically solve their pain point and do it at scale, you will win. This market that we are all so privileged to be a part of right now is one of the largest, fastest growing markets anywhere in the world. And our entrepreneurs who sort of almost set aside the distractions of valuations and all these up rounds, but really fundamentally go to work every day to understand the customer need and how it's evolving, and building products and services that actually do that, are the ones that are actually winning in the marketplace. I think the only other lesson I would want to share is the sheer ambition of the average person coming out of an IIT or an engineering college or a B school today is 10x larger than we've ever seen before, which is wonderful. People would have wanted to be the next, or looked at role models like the industrialists, like the Ambanis and so on and so forth. And then we looked west for the Elon Musk and so on and so forth. But if I may be as audacious to say, I think anyone coming out of school today really wants to understand how Dipinder built out his business at Zomato, or how Girish from a small town in Trichy was able to sort of create a company called Freshworks that started off in Chennai, but is really a global company that happens to be from India today. So I think the role models are changing for our next set of entrepreneurs.
Nayantara, if I could add to what Mohit is saying, I think while this has been a spectacular year and we should celebrate, what looks like great outcomes, we should also remember that this is kind of beginning of a new responsibility. These are companies that have shown that they can go public, but they're now dealing with shareholder capital and a wide base of shareholder capital, and they are also signing up to becoming enduring businesses. And this is really what we talk to all our companies about, which is how do you go from being a good company to an enduring company, which means you want to be able to kind of compound for many years and continue to create less shareholder wealth and value for consumers. And this is something that a few of companies have shown this year, and we hope many more take the path and see it as an example. Don't see IPO as an outcome. It is a milestone, but it's certainly not an outcome. It's a new beginning and a new responsibility to build something that's enduring. So we really want more people to emulate some of these successes we have seen, but these successes are really efforts of many years and a new responsibility that both those founders you mentioned have signed up to.
And I think they're rising to the challenge, they're figuring it out. And as they do that, Mohit, a lot of the founders that we speak to, for example, and, maybe it's a fashionable thing to do, or they believe in it when they still say it's day zero, whether it is on listing day or whether it's, some of the others which are minted and they become a founder, when they become a unicorn. So while it might be day zero, day one, all of that, do you think the ecosystem also needs to remember that sometimes what goes up must come down, or the easy money will also go away? It's a reminder that we keep getting from various central banks around the world too.
Yeah, I think that's a very important point you underline. And I do feel like any entrepreneur who has reached this level of success, let me assure you, has gone through some really tough times, has gone through the dark days, has gone down to the near death experiences. We don't know in our history at Sequoia of any company that succeeded without its very, very dark days. And so anyone who's been through that and then survived is paranoid, is also very humble to realize that success and failure is just a whisker away from each other. And so when someone says that they're day zero, it hopefully sends a message to everybody and their troops in particular that they want to build an institution that outlasts them. And the only way that they can do that is that they actually think like they were when they first started off, first principles, very hungry and very humble. The other data point I'll add to you from our Sequoia's history is we have seldom seen one of these companies get disrupted by a large company. Oftentimes you're asked about, why would you back this company? There already are two giants in that space. But the single biggest competitor that is available or in front of our startups is actually the next startup. Somebody much like them 5 years or 10 years back, looking to sort of disrupt them because they have nothing to lose. And I think that is why that first day mentality is so important to keep many of these guys on point.
Oh, absolutely. Aren't we all talking about Meesho like that? Meesho disrupting the giants from a Flipkart to a Walmart. Really, really important to remember that. And GV, when you do that, when you look at investing into all of these companies, and I'm going to ask you if you can be candid about this. Do today's valuations make sense to you folks? GV, you take it first.
Yeah, I think there's a significant gap, a wide gap between current valuation and actual value creation. I think there is no taking away from the fact that a lot of us and the companies that we back have been beneficiaries of the significant liquidity that's come into the markets. And so the question is really how far away are these gaps and how quickly can you bridge the gap by growing into those valuations. So, it was not uncommon in the early stage in the venture ecosystem to pay 12 months forward for a company, assuming a certain growth rate. Now, the issue is if the company fails to deliver on that, then it'll look even more expensive and you kind of have to face the consequences. But if the companies can grow into those valuations by delivering on the promise that they're making to investors in terms of the growth, in terms of customer acquisition and potentially profitability, then some of these will look less expensive as they're compared to where they're looking today. But I think truth be told, today's valuations, sometimes we scratch our heads and say, what are we missing? Why is something that's kind of just started yesterday worth several hundreds of millions of dollars? So yeah, it is a heated environment. No two ways about it. We hope people kind of grow into those valuations by delivering on the promises they're making.
And Nayantara, if I can add on that, just to show you how different we each are, and I'll take an opposite polarized view of GV, just to make this more fun. And this, by the way, represents the way we think at Sequoia. It's constant sparring. I feel, who cares what the current price is? I feel like investors who enter into these kinds of companies are in many ways trying to find companies that shape the future. And our real judgment call is this management team, is this founder, is this particular thesis something that, where time is your friend and you're going to be, the dominant player and the leader in this new market segment or not? And if you find that right company, that right founder with the right product who's executing well, then frankly, it really doesn't matter what the short-term valuation is, whether the share price is up or down. The real important question to ask yourself is, in 5 or 10 years later, can you pretty much hand on heart see this company being magnitudes bigger? And I think, at least for me, that question is more important than whether today's markets are heated or not.
Mohit, the other thing I wanted to ask you folks was, and I'm going to ask this to both of you, there seems to be a belief that if a startup or a VC-backed company is going in for an IPO, it must, of course, be loss-making, but is in hyper-growth stage. But that's not necessarily true, because if I were to look at the Sequoia portfolio itself, Mohit, not all the companies that went to Dalal Street were loss-making.
No, it's a great point, Nayantara, and I'll broaden it by saying one of the highlights of the 8 IPOs that we were so fortunate to be a part of this year is the sheer diversity that is represented within that set. On one hand, you have the Zomatos of the world that are going after the consumer internet opportunity in India. You have a Freshworks that inherently is building a very high gross margin business in the software space, but lists in the US. You have a company like Indigo Paints, or most recently, just last week, Go Colors, which is a consumer brand that is, servicing the needs of the Indian customer. And then you have a Truecaller that's not even an Indian company that's getting built on the back of a opportunity here in our country. So the sheer diversity of the types of entrepreneurs, the different profiles of the businesses that they run, some of them, higher gross margin, some of them lower gross margin, some of them growing at a nice clip of 30 to 50%, some of them wanting to double at this scale. That sheer diversity shows that there isn't one way to sort of win in this market. There are many ways and there are many paths that each one of these companies will take. I believe out of the 8 that we've had, close to 4 or 5 of them were already profitable, and others will have a close path to get there. And whereas there will be others who are signaling and guiding from day one that, look, the opportunity is so large, you want us as shareholders to be investing today so that we can reap the benefits in the future. So no one size fits all is the way I would cap it.
So, GV, building on whatever we have discussed so far, what would the message be going into the new year? We are done with wave 1 of the IPOs, right? From a Zomato to a Freshworks at NASDAQ, to a Paytm, etc. When we enter the new year, there's going to be a brand new wave, from a Farm Easy to an Oyo to an Ola. The list goes on and on. What would be some of the lessons, and how important is it to note that some of these companies are now trading below their IPO, at least at the time of this recording?
Yeah, look, it's a great question, and something we think of as we look back at the year. We kind of really feel a lot of gratitude for the journey that we've had, for the kind of year it's turned out to be, with all these spectacular IPOs, support from the broader investor community for Indian technology startups to kind of be listed, companies, etc. I think we have a lot of gratitude for what's happened, but we also think there's a sense of huge responsibility. This is kind of markets voting in favor of saying, hey, a lot of market cap will accrue to technology companies, and here is the first list that they've seen, which they've supported with their dollars, to say, hey, we believe that this kind of value creation will last for many years. Now, this will not be there, this will not be a smooth road. There will be bumps along the journey. Now, who knows what changes, when the liquidity environment changes. So there will be some bumps on the road. So the thing that we, are advising our companies is to just recommit to first principles, recommit to, doing what's right for your consumer, recommit to kind of building companies the right way. In bull markets, we've often found that, founders as well as investors. There's lots of kind of bad habits that creep in, and we tend to be more loose and liberal with what we do, and that can change, and the environment can change. Like Mohit said, success and failure are just very close to each other many times, and we wouldn't know. And some of these habits kind of tend to continue even when the markets turn. And so at least our advice to founders has been to kind of recommit, go back to the basics, make sure we are looking at businesses and building them the right way, so that we can end up building more enduring businesses, which hopefully then the markets will see as compounding long-term businesses that will reward all shareholders, at the time of IPO, but also more importantly, beyond for several years. So really just the core message is, let's go back to the basics. Let's not get carried away. Let's kind of really focus and double down, take the capital that's been made available to you, and then let's do the right things for the very long term.
So Mohit, what would be the message to the founders as well, right? And I'm going to play devil's advocate here. Look at where they are. They're hungry, they're ambitious, they're pivoting, they're agile, and they've got all this serious, easy money chasing them. They're human too. It will get to them. It is bound to happen. Are you seeing that?
Yes, we are. Like I said, these folks are very special individuals. They've gotten here because they've gone through some pretty tough times. People don't forget that. And so when you're faced with a buffet, you will be very selective. When you have options, they're very carefully looking to see, who's behind that money, what strings does that money come with. And they are thoughtfully finding partners who can, one, complement their existing set of investors, open up new opportunities for them, if you will. Second, they're looking for folks who are long-term. They're looking for folks who are willing to sort of say, look, I may be entering at a certain point in the market, but if I sort of have a longer term 2 or 4 year belief, I'm very likely to be in the money with you. So is it the right thing for these folks to be raising money when they don't need it in an opportunistic way? I think so. I think it makes a lot of business sense for our founders to actually build up balance sheets and build up war chests so that they can use them appropriately. The smartest ones understand that this doesn't mean that their company is valued at that today. The smartest ones understand that this needs to go into a balance sheet that then sort of allows you to, play the long game, perhaps even consolidate the market, perhaps even invest into adjacencies that you wouldn't have normally gotten into. And so they use this opportunity and this wave to actually build bigger moats in their business. But I think someone who actually believes they deserve this, and there is more of this coming and constantly coming, is in for a rude shock.
As we wind down this interview, Mohit, I've got to ask you this one question. Just the number of unicorns that were minted this year. People are saying, is it even as mythical as we used to talk about? What are your thoughts on this? Or now should we only talk about decacons? We don't have enough decacons.
Honestly, Nayantara, we don't like, at least I don't like the term unicorn at all. I think it represents a moment in time. It represents a number which is more to do with what the outsiders perceive your company to be worth, which oftentimes is driven by FOMO and driven by scarcity. But I think the more interesting metrics are those that how long has your company withstood the test of time? How many cycles has it seen through? What's the total absolute revenue, not some artificial GMV vanity metric, but the absolute revenue that you're generating. One of the metrics we use within our system is we count the number of companies every year that cross over $100 million of revenue, of real revenue. And look, in any market, if you get to a company that's growing at, call it 50 to 100%, and they've crossed triple digits in their revenue base, it's very likely that company is going to be sustaining for a period of time. And so those are some of the metrics that we key our decisions off more than anything else around unicorns.
There's been a lot of chatter, at least on social media, and long threads being written about, remember what happened during the tech bubble that we saw. GV, do you take that seriously? Do you think we're possibly headed that way, or is it just going to be like markdowns or just getting more realistic?
No, we should take that seriously for, what lessons are the right lessons to learn from history, right? So, when there's madness, when there is exuberance without underlying performance, and this is the point that Mohit's alluding to, if you don't have a company of some revenue scale, which is kind of, has a real solid foundation, then, when the tides turn, it's not going to look pretty. So, we have to learn the right lessons from the past. Just because you change your name from something to something tech, which happened, by the way, in the dot-com bubble, any company named which has a tech or a software in it was getting traded up, and that was the kind of madness we saw in those times. And the same thing can happen. Just because you use technology, you expect to be valued a lot higher than the business that you're trying to disrupt or change. These kinds of things are more vanity. I think you go back to saying, look, are you really solving a consumer pain point? Are you hence being rewarded with some value for that, in terms of people paying money for the pain point you're solving? And if you can get to scale with that, that's really the right metric to watch. And there will be some markdowns. There'll certainly be some companies that don't survive when the funding environment becomes harder. But that's par for the course. Why should we not take the bad when there's so much good happening as well? It's the balance that will keep this sustainable over the long term.
Founders, VCs, merchant bankers, are you listening? This should all be your New Year resolution. As we wind down this interview, let's also not forget the year that was. And, a year where we saw the deadly second wave of coronavirus, and a year where we also then saw you guys actually also come together along with the ecosystem to just make sure that many of us in Delhi survived. Mohit, when you look back, was that like, is that something you remember more than, let's say, a Zomato IPO or a Freshworks IPO?
Yeah, I look, person by person, family by family, I think we were all surrounded by sadness at a level that we had never experienced before. So the fact that we all came through this and we came through it together, certainly, I think, has shown us that when everything else goes to hell, there is that human spirit that can still be counted on. And, just one of the highlights for me, even though we went through the toughest period we ever did, was how our startup ecosystem came together to try and battle the second wave. This is, certainly GV and many others were at the forefront of driving this, but we had literally partners and, founders all across our ecosystem. At one point, we had over 350 volunteers who stepped up for, helping the country deal with this crisis. It came under this platform called ACT, which we put together last year, actually. And last year, we had done some experimental grants to see what solutions could innovatively, put a dent into the virus. But this year, we had no time. And so we actually took all our learnings of last year and put it to work towards oxygen and home therapy and vaccination. And these were the three initiatives that the entire volunteer group, sort of went after with the help of all the wonderful donors who stepped forward. And if it's okay with you, Nayantara, I'd love to spend just a couple of minutes to tell you a little bit about why we are doing ACT and why, all of us are sort of so excited about it. We put together a few lines, which is on our website. We call it our charter, but here are a few lines for you. We believe anything is possible when founders, investors, venture capitalists, and tech entrepreneurs come together for a larger purpose. We believe the startup ecosystem has the power to solve societal problems at scale. We believe founders who build successful businesses can also build the foundations for a better world. Leaders who create great shareholder value also have the empathy to create greater shared value. We believe in collective action. And so in many ways, that's been sort of the unifying force for a lot of people in our startup ecosystem to deal with this very tough period.
I think that also, I'd like to thank you as a citizen of Delhi for how you all came together. I remember contacting some of you at that time, being lucky enough to be able to do that, to just try and organize those concentrators for the hospitals and all of that. It was really, thank you is what I'm going to say. And with that, I'd also like to thank you for taking the time out, for joining us here on ET Now. Lots of valuable lessons. And one of the biggest ones also, what Mohit just ended with, when you come together, what can go wrong? I think let's remember that for the new year. Many thanks for watching.
Thank you, Nayantara.
Nayantara.